Herr Bundesrat, Excellencies, ladies and gentlemen, I'm fully aware that my time is already over. But I'm very thankful to you that, Lord Griffith, that the practices here are not as severe as in the Swiss Army. It reminds me of a time when I had to have a presentation in the Divisional General Staff, and in the Swiss Army, speeches were timed like a Swiss clock. So the guy who introduced me said, now comes Captain Kielholz, he will introduce the problem we have to solve to you. Unfortunately, his time is over, so we skip him, go to the next speaker, he will present the solution. So, things were slightly rigged against me. The opening film we saw a few minutes ago, Mr. Risk, and he said, by avoiding me, you create a situation where I have no choice but to camp on your doorstep. I'm not Mr. Risk, and I'm not to camp on your doorstep, but I gladly participate in this effort to actually shape a little bit the problem in my short speech. Actually, the film makes an important point when it illustrates different responses to risk. These behaviors are real, and many of them may seem legitimate in given situations. This is even true for avoidance, which is an element of risk prevention. But you can only avoid what you know, and often one may be unaware of potential risks. The ignorance, or the unknown, the ignorance about consequences of decisions one takes, or may take, or may not take, is the biggest risk you actually confront. Understanding your risk is therefore the most important responsibility you have if you are a senior person in charge, or you are a person in charge, be it in your family, be it in your company, be it in government, be it in NGOs, be it everywhere. And I agree with Federal Councillor Maur's view that in a liberal economy, the private individual, the private institution, has a lot of room for maneuver and responsibility, more than in other systems. And this also means it has a bigger obligation and responsibility to properly assess the risks associated with entrepreneurial, economic, but private actions. However, I also share his view that I cannot avoid to be the impression that society is first today about avoiding risk, about actually not understanding that we have to deal with that in a positive way. Risk can be simply defined as an uncertainty about outcomes that can be either negative or positive. And when I listen at what in America is called the Monday morning quarterbacks, about those who write in the media after the event has happened, that one should have seen it coming, when I listen to them, I think we are more and more ignoring the positive aspects of risks. We see risk as a negative bias, as something that can go wrong. But the decision and the outcome has two sides, the positive and the negative. Companies in particular establish risk management processes that try to reduce this uncertainty. The first element in the process is to define a risk policy. It defines the risk appetite an organization has, the risk which it is prepared to accept based on its resources available, on its human resources, but in particular also on its capital resources. The resources it has to absorb and manage loss situations and investments in opportunities. The risk tolerance is determined by capital requirements in many industries set by the state, the specific business model, and above all, by how the company in itself perceives the different risks it takes. This policy forms the basis for the development of a proper strategy around risk-taking, which describes the goal of the risk management and defines also the measures or the tools how to measure and control these risks. And those measures in turn determine the financial protection that is needed, for example, if applicable through insurance and other risk financing options. The risk strategy is the core of the risk management process and guides all its elements. Time spent on defining risk management process and policy is time well spent on the agenda of a chief executive. First of all, the time you spend afterwards to pick up the pieces after the road crash is much more extended and, by the way, much more expensive. 3 items are essential in the risk management process. First, the risk assessment, and that was also lined out by Federal Councillor Maurer, was to understand what actually the risks are, identify the hazards, analyze them, and quantify the financial or societal or whatever impact they may have on your balance sheet, on your resources. And this is true for states. States have to make the same risk assessment process, and more they do. Whilst in the past, most of the risk assessment was around defense, now the economic threat and societal threat are taken into considerations also when governments make risk assessments. The second step is risk treatment that controls the risk through avoidance, prevention, reduction, or for financial institutions, other institutions, also very important, diversification, to name the most common practices only. And part of risk treatment is also the decision about risk transfer and the decision how much of the risks you actually incur do you want to retain in your own family, in your own institution, and how much do you want to trade on. And finally, risk monitoring has the task of evaluating whether the reality has anything to do with your plans and with your assessment, and provide feedback to actually correct your risk policy if that is necessary. Even such a brief review of risk management practices shows how dynamic and complex this process is. I understand facing risk as an attitude that is ready to deal with all these aspects, and it's always on the road, it never arrives. But facing risk is more than a process, it is also a proactive behavior that creates a robust risk culture. The recent financial crisis has demonstrated how important sound risk culture is for companies, but for whole economies and countries and regions in the world, and that it does not only build on risk models and governance frameworks alone. It is also, and in the first place, dependent on individual behavior. People make decisions, not models, to take tough decisions in good times when things seem to sail on, to cruise. Well, takes these decisions needs a lot of courage, both in an enterprise, but in particular in a government or in a society. Let me say some words about major challenges we face in today's risk landscape that has evolved during the past crisis years, and if we are honest, the crisis now actually lasts since 5 years. The 2012 reports on global risks published by our larger cousins in Davos, we have no problems with, published by the World Economic Forum, and the Risk Response Network, where Swiss Re is a partner, lists chronic fiscal imbalances among the top 5 global risks, both in the term of likelihood for consequences, negative consequences, and in terms of size of impact. In addition, major systemic financial failure is ranked highest in terms of potential impact. This perception of risk is closely linked to the geopolitical issue of governance failure, which manifests itself in the fragility of states, skepticism about globalization, and growing income disparity across the globe, also mentioned at the beginning. Of course, that has to do with perception. It's not necessarily always reality. And I always call it the ligne Maginot effect, the Maginot ligne effect, the tendency of a society, of an institution, to fight and prepare for the last war. So all these, if you had done the same interview 10 years ago, people would have said terrorism is the biggest threat. Nobody would have mentioned chronic fiscal imbalances. But they were well in preparation, they were already there. So it has a lot to do with perception and also what is driven by the media. We have to add to this also the resulting rising impatience of citizens in countries where their elite, an expression which has become unpopular, of course, over time, but which seems to be extremely necessary, in particular also in crisis, where an elite is perceived to be unable to redress the problem at hand. Countries in many parts of the world where regimes are unwilling to share power with their people and get into a proper dialogue with their citizens. Together, these trends erode trust in political institutions as well as in the corporate world. Or, in short, it erodes trust in the concept of an elite who acts in the best interest of the society at hand. Reforms are certainly crucial if one wants to address these crises, each of them and all of them in their interdependencies. The word crisis can be maybe best defined as a state in which options to act seem severely limited. So you seem to be in a situation where you don't know how to get out of it, or you cannot imagine an efficient and quick way to get out of a crisis. To regain this ability to act in a responsive as well as in a responsible manner, in a quick but well thought through manner, is therefore paramount. But just that, given all the interests at stake and given the cacophony of opinions in the universe, exactly that process becomes very difficult and seemingly impossible. Every attempt to solve a crisis will carry within it the seeds of a potential future crisis. Somebody said the road to hell is plastered with good intentions. This is not meant as a fatalistic remark, but it also shows that every action one takes, every severe intervention one takes in a crisis situation will carry the seeds for the next problem. Take, for example, the low interest rate environment as an example. Flooding the markets with liquidity was an appropriate mean to stem the financial crisis at the time, when markets and interbank markets and the whole financial system came to a screeching halt. It was also politically motivated, and while it successfully addressed the issue of systemic risk, it has already led to a problem for another part of society and the economy. For insurance companies and pension funds, for example, for the saver who has now the results of his savings too small of a return on his savings, and therefore his whole plan for his future has come to a stop because he doesn't now have the means out of his savings to guarantee a proper living standard in old age. And eventually this becomes a problem for all the consumers whose savings suffer and who may be forced to look for financial products with higher returns and therefore higher risks. So by solving the one problem, we have created the other one, and so the whole system has to go and pendulum, and the pendulum has to swing back into the middle, not in a too far future. I would like to illustrate this dilemma also by a brief look at the unforeseen negative consequences of regulations highlighted by the 2012 report on global risks, financial regulation. And the recent crisis has changed the way regulators in society at large look at the financial sector. The emphasis has shifted from market efficiency, which was the word in the 90s in particular, to financial stability and regulation. And whole armies of regulators in the whole of the world are at work to actually get the tiger back in the cage. This is particularly marked in Europe, where politically there has always been a feeling, a mistrust in the liberal society. It has always been the question, yeah, the liberal society is okay, but not too much of it. Too much of the good medicine is bad. Federal Councillor Maurer has pointed out that the European Central Bank more and more assumes the role of a transnational political power, seen at least from Switzerland sometimes. However, I see, with many others maybe, the institution of the ECB as a positive force at work and not as a negative force at work. And largely thanks to Jean-Claude Trichet, who happens to be with us here today. But of course, central banks, in the context of the financial crisis, have assumed additional roles and are now playing the macroeconomic prudent regulator to some extent. At the recent meeting of the European Financial Roundtable, that is a union of chief executives of very large European financial institutions, which I happen to chair, which is also a strange thing that the non-European, like me, is chairing a European financial roundtable, but I'm happily accepted by all of them, probably because they can't agree among themselves who should chair them. At this last meeting, we had discussed the consequences of regulatory reform, including Basel III, Solvency II, and its unintended effect, accepted but unintended, on growth and growth creation, credit creation, investments in Europe. And all of a sudden, if you read now the newspaper, this topic of growth is the main topic that has come back. And the pendulum is about to swing backwards, and people will say, hey, wait a second, we should create growth. The concept of regulation, austerity, and so are under threat. So the debate is ongoing, and it will never end. To enhance the stability of the financial system, regulatory regimes need to be coordinated at national and international levels, as well as across the insurance and banking sectors and all financial sectors. Policymakers need to appreciate the differences between the various financial sectors and the combined effects of new regulatory regimes on them and on the growth capacity and the fabric of the economy and of the society. Coordination is needed, not harmonization. One size fits all will lead into another problem, into another crisis, sooner rather than later. So let me close on this note. I have another few positive notes. I leave them out because my time is now over. I mentioned this. I mentioned all this because a comprehensive risk-based approach, also on regulation, can ensure the implementation of sound practices of risk governance. But it is one element which is particularly important, and I agree there again with Bundesrat Maurer, is the fact that the financial reputation interest of the individual to keep his things in order, to control his risks, but to also assume risks, because without risks and without assuming proper risks, there is no progress. With the individual incentive to do that in a proper way, that is the most reliable element for risk management in every society. And don't forget, risk management, as I said at the beginning, is something you do every day with your family, in your non-government organization, in your government organization, in your pension fund, in your company, wherever you are, you do risk management, knowingly and unknowingly. And therefore, I would, skipping the good news, I would like to end here slightly abruptly, but in knowing my time is now over, and I wish you an interesting discussion about risk management, an interesting discussion in particular about the multifacets of this question, a question which has always fascinated me throughout my now 40 years professional career. Thank you very much for your interest.